If I were to translate it, I would say it was a triumph of Bannonism and Steve Millerism, that multilateral institutions don't matter to the United States, that economic nationalism is going to be more pronounced going forward than it might have been.
America first.
America first. In even a more dramatic fashion than we've seen thus far. And so as a consequence, some of that is good for Wall Street. The tax cuts, deregulation, all of that have helped corporate profits, but not helped the stock market, rather ironically. We've seen stocks fall in a year when companies have bought back $1 trillion, or at least announced $1 trillion in buybacks. So I think the longer term risk is that the breaking of alliances, which is the kind of ultimate goal of Steve Bannon and others who have the president's ear now in full, it shows much bigger political, economic, and geopolitical risk than we've seen in a while. And so this level of uncertainty, and I hate that expression, has the market back on its heels.
Sylvia, when it comes to the flows that you're seeing, I mean, you point out that unfortunately it's the inverse ETFs that are actually seeing the most successful performances, no surprise, in the year. Technology ones, semiconductor ones, small cap ones. Of course, the sectors that have been beaten up the most are seeing the most success in terms of the inverse ETFs. What are you seeing in terms of the flows at this point?
Sure. So it's, unfortunately, we're seeing continued flows, but it's not all bad news. On the bear side, as you said, tech, semiconductors, and also a lot of the oil-related ETFs for us. So anything nat gas, energy bear, S&P oil and exploration ETFs on the bear side have performed really well, low double digits over the last couple of days. But on the bull side, we've seen some flow too. So a lot of investors in this market are still looking for, what to do, where to allocate. And, we just saw Bob Pisani put up the top 2 performers today, Procter & Gamble, Nike, and you've got discretionary and staples there. So, we see investors kind of transitioning to a sector like consumer staples, for example, where
they're buying the bunker. I mean, that's the bunker ETF, right, Sylvia?
They are.
But in terms of the signs that you might identify in terms of fund flows and other things in your business that might point you to capitulation, what would those be? What would those be? And have you seen any whiff of them so far?
So, the flows are telling us right now that the market is bearish on growth and becoming more bullish on, defense and value types of plays, and also, names like emerging markets. So basically anything that's sort of, gotten crushed and might look like a value trade with some positive upside, like emerging markets, for example. We see flows into the bull funds. And again, that's sort of like country specific. China potentially easing fiscal policy, Brazil, stable president, Mexico not repaying the airport bond. So we're seeing flows into emerging markets. We're seeing flows into consumer staples, again, consistent demand, persistent div yield. And we are seeing flows into the bear funds, again, on the growth side. So it's the big FANG names, again, pulling the market back.